You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, everyone. Welcome to the Infinite Banking Mastery Podcast once again. Thank you so much for being here. I appreciate you. I appreciate you listening in and sharing the podcast. Thank you so much for all those who are doing so. Today, I wanted to talk about maximum insurability. What is maximum insurability and how does it apply to you? A lot of times when I'm talking with clients, one of the big things we're trying to piece together is how much coverage should they have in the first place? Because for when we're solving for infinite banking, we are solving for cash, not for death benefit. And so that will definitely lower the death benefit on your whole life policy because that's what we're doing. We're doing that on purpose. We are purposely trying to lower the death benefit because when the death benefit is lower, so is your cost. So we are minimizing the cost so that we can maximize your dollars and grow your cash as efficiently as possible. But in the meantime, if you actually need or would like higher coverage to protect your family, we could look to see what amount, how do we come up with that amount and what amount could you qualify for? So there might be two different things, how much you actually feel you need versus how much you could qualify for. And of course, I like to help clients understand how they could maximize or build on their banking system if they lock in additional term insurance, which might hit two birds with one stone, depending on how you feel about how much coverage that you need. You might be able to protect your family further. And then also it gives you the ability to grow your banking system with no further health or financial underwriting when you have that additional term insurance. So how do we figure out what your maximum insurability is? Insurance companies are actually looking at a multiple of your income to come up with your maximum insurability. So for example, for those of you who are 18 to 35 years old, your maximum insurability is 30 times your income. For those that are 36 to 45, your maximum insurability is 25 times your income. And it goes down from there 20 times and then 10 times and 5 times. So it goes down and it's just based on your age and, give or take approximately how many years you have left to retire. It's not a perfect science, but that's in general how it is. And it might be different a little bit for different companies. They might have a different multiple than the one I'm going off of. But that's basically how they come up with your maximum insurability. And so for some of you, you might have a certain income and maybe you just have a lot of assets that you've acquired or that you've inherited. And so in that scenario, an underwriter will take a look and maybe allow you to have more insurance or a higher premium based on your assets. For those who are seeking life insurance coverage over $5 million, the underwriter will want to see some more information. They may want to see tax returns and personal financial statements. They may need third-party verification of these financial statements. It's a little bit more intensive when you're over $5 million. But generally, pretty simple. They just want to see what your income is, and then they have a multiple for how much you can acquire as a total. There's another kind of general guideline that they're looking at when you are wanting to acquire a whole life policy. A lot of times people want to really fund these pretty high and they have the resources for it and they have a plan for the premium. But underwriters will look to see, well, geez, how are you going to pay that premium? It's more than 25% of your annual income. So they will look and ask questions when we are something over about 25% of your income. Of course, if we have a reason, if we have documentation, if we have an explanation, they will allow that. Of course, there were people out there just encouraging people to do things like maybe take a HELOC out and start funding the heck out of life insurance policies. And for some people, something like that, a strategy like that might work, or it might work a little bit. Maybe they use some of their HELOC funds, but people were promoting this, and then the insurance industry was like, no. And other things, not just that sort of thing, but they were promoting things that the insurance company didn't want us to be encouraging. So they have restricted now how much of your income you can fund into a whole life policy, unless it makes sense and unless there's some reasoning or explanation behind how you will afford it and why it makes sense for you. Sometimes with clients, we're not really looking at your maximum insurability. We're just looking at what makes sense for you as a family. Do you want to be able to pay off the house if something happens to you, or all the debt, or maybe fund your children's college careers or their first car, or whatever it might be? You might want to just consider those things because oftentimes, too, the spouses are relying on each other's income. And once you've lost a person's income, that's a big deal. That's a lot of times people have to move out of their house, have to go out there and get a bunch of jobs when they're mourning. So you don't want to have something tragic like that happen to your loved ones when you pass. And in addition to relying on your spouse's income while they're alive, you might also be relying on what they're saving into their retirement account or what you've planned together, what you've been putting away together for your future retirement years. So then that person passing away too young, that might have a devastating effect on the surviving spouse's retirement account as well as their current living situation. And so having that death benefit from the life insurance, of course, boosts that as well, helps them to not have to rush right out of the house and get 5 jobs while their children are mourning and they're all mourning, but instead take care of the household and then even maybe have some of that money go towards an account or another banking system for them to prepare for their future retirement. Because one thing's for sure, people will often say, oh, maximum insurability, that's a heck of a lot of money. Why would I need that much death benefit? But if you were to actually survive from now, your age now to your retirement age, most often the death benefit that you could acquire will be less money than you will be able to earn if you live that long to retirement. And then we're able to earn your wages all through that time. So it's less than what you would earn if you survive that whole time. So it's not really too much if you look at it. If you're thinking, well, I'd want this if I was alive, my money would be here to support my family, support all the things we need, support my spouse and my retirement and all of that. So there's just a lot of things to take into account when you're thinking of how much insurance should I have? Tell you, I have a story of a friend, a person that I used to work with that I trained at one time, who got into the life insurance industry because her spouse had passed away and they did have a death benefit on him. So she received approximately, I believe it was around $500,000 from when he passed away. It was tragic. They were all very sad. And so she was grateful she didn't have to rush out and figure out how she was going to get by right away when he passed because she had that. And they were in their 40s, I would say. But this person, she ended up jumping into the life insurance business because she realized how valuable it is and it saved them. And even still, even though she had that large lump sum of money, which seems like sufficient amount, she still lost her house because had she kept the house or paid off the house, she would have not have had the resources to do anything else, to help fund the kids for college or school or their cars. I mean, like one of the kids got into a car accident and he needed a new car and the insurance didn't cover it all. And so she still ended up leaving that house and moving somewhere else. And so when you're thinking about how much of a death benefit should I have, just think about what happened if something happened to me tomorrow. How would I want my family to be able to proceed? What would you want them to be able to do? Would they be able to keep this house? Would you like them to be able to pay off all the debt? And if they did pay those things off, would they be able to have enough income to do the everyday things? Regular car payments or cell phone payments, utilities, food, those sorts of things. You just got to think through, how would things happen if I wasn't here tomorrow? And so for us, our family, for my husband and I, we have the maximum insurance that we could get every time we go through underwriting, because of course we've been through underwriting more than one time. We get the maximum amount of insurance that the insurance company will give us based on our income, those multiples that I covered earlier. We acquire whatever we can. We, at the time, will acquire whatever whole life we're trying to purchase or build. And then on the side, we will acquire term insurance as well to cover our maximum, because our maximum insurability has gone up over the years, because even though we're aging and our multiple is going down for that, our income is increasing. And so the multiple of our higher income yields a higher maximum insurability. So we will acquire the maximum, and then it will be there to protect our family, because even if we were able to work until we are retirement age, it's still not going to be the same amount that there would be in death benefit to cover had we been able to work those years. We would have made more money being alive and working. So we have the maximum insurability to take care of our family and to be able to continue to grow our banking system in the meantime. We've already converted 3 term policies, and so we will continue to do that, continue to convert our term. And we will continue to purchase term when we go through underwriting and continue to build on our banking system and continue to increase our maximum insurability. And the one good thing about that too is that when you have that term, you are able to convert that with no issues. So if you are wanting to, somehow you have enough resources and it makes sense for you to end up putting more money into whole life insurance, maybe 30% of your income or 35% of your income, where normally it would be an issue with underwriting. If you're converting term, it's a non-issue because you're able to simply convert that whenever you want and with whatever funding you're able to put into it. So that helps to eliminate that obstacle as well. So, of course, as always, if you would like my help to think through some of these things, if you would like to work with me as your advisor, please reach out. I would love to connect with you. You can reach me at Valerie@alphaomegawealth.com. I do look forward to meeting you and chatting with you, and I hope that you have a great week. That's all I have for you today. I will talk to you again next time. Take care.
This is thepodcastfactory.com.